Lots to talk about and break down on this week's program, Chet.
Absolutely. It's been extremely volatile in the past week with all of these tariffs announcements. There's just a lot of uncertainty in the market, and we're certainly feeling that, and that's the topic of this segment here.
No, that's exactly right. So I think, there is a lot to talk about when it comes to volatility. I mean, I think, Chet, when we were preparing for the program this past week, you brought up the notion of, well, there's some math at play here that skews perspectives, if you will.
Yeah, no, absolutely. The Dow Jones is one of the indexes that I think we pay a lot of attention to, and for good reason. It's been around the longest, dating all the way back to 1896, so it certainly has a track record. So for example, a 1,000-point drop, it certainly creates a lot of headlines, and that sounds like a big number. People throw 1,000 points around, but it's important to have some mathematical perspective in terms of just how much the index has grown. It doesn't mean as much as it used to at one point, because 1,000 points, it's less than 2.5% of the index at its current value, where at one point, it would have been a 10% decline, at a smaller value of the index, a smaller size. So I think it's important to use percentages instead of just the actual point value that has dropped, because it creates a lot of fear that is probably unnecessary.
Yeah, I mean, that's always the case. I mean, sometimes the absolute numbers, particularly when we think about point declines in the market, don't quite mean as much as they used to, right? Because if there's been growth, then 1,000 points doesn't mean as much today as it did back 20 years ago. That's for sure. And of course, in today's world, there is a way to sort of measure fear, I'm not sure it's necessarily an accurate measure of fear per se, but it's certainly an accurate measure of investor sentiment. It was started in 1990, so been around a little bit, but not, certainly not as long as the Dow at 1896, but referred to as the VIX. So for those folks that maybe were listening a little bit to the media this past week, you might have heard them talk about the VIX. What that stands for is it is the Chicago Board Options Exchange Volatility Index, also kind of known as the Fear Index, if you will. And what it measures is sort of the market's expectations for the relative strength of kind of what the near-term price changes are going to be in the S&P 500. The VIX can be traded using options, ETFs, things like that. It is ultimately calculated on a on a regular basis. I mean, every second of the market, it's getting calculated to sort of produce a measure of the 30-day, forward expected volatility of the U.S. market, derived from kind of the pricing of the different companies in the S&P 500 in terms of index calls and puts and so things like that. So obviously it's got a convoluted formula. It's not just looking at kind of the S&P companies, but it's really looking more at that call and put types of strategies that are going on. So it's a complicated formula. Of course, it has an index relationship, right?
Sure.
So if the VIX is high.
Right. It's really the easiest way to think about it is it's a measure of price action, I suppose would be a good way to say it. The quicker and more violent the swings of prices of different things, one way or another, good or bad, up or down, the VIX will go up, and if the market is trading more flat, then it will go down. It's more of just a measure of how violently prices of different assets are flipping around.
But definitely sort of like an inverse correlation,
right?
Absolutely. I mean, the VIX is going up and the market's going down, the market's going up, chances are the VIX is going down. A VIX of say 20 or less, generally, everything's, all's calm, start to get above 30, then you'd say, okay, things are getting a little bit more anxious.
Right.
Start to get above 40, okay, then people are pretty nervous. Interestingly, that 40 threshold, not hit very often. Something like 60% of the time that VIX above 40 threshold has been hit was all the way back in the global financial crisis. Most years, I think like 25 of the past 34 years, the VIX doesn't, kind of break above 40. The VIX is definitely jumping around a lot right now.
Yes. Yeah, the VIX, seeing a number above 40 is certainly rare. We saw 30 on Thursday. So yeah, I mean, we're certainly at a period of fear right now, not quite at, world falling apart. But the VIX is certainly not happy with what's going on in the market right now.
Well, and yeah, I mean, for the day alone on Thursday, I think the VIX was up 40%. I think Friday morning it shot all the way up to 46.
Okay.
So early Friday morning it hit that 5-year high. So last time we saw that kind of a quick spike, it was last August, where it jumped up to 40. On fears of recession in China and all those kinds of things. So the VIX obviously gives us a good measure. I mean, I guess don't necessarily need a fancy stock market measure to tell us that people are nervous, but okay, the VIX would certainly support that contention that yes, in fact, people are nervous. But Chet, there's also something interesting that helps to put these numbers a little bit in perspective as well.
Yeah, I guess the question is how normal is some level of volatility? And I have an interesting stat here that I wasn't even aware of before this, and it's very telling of how the market tends to perform over time. So from 1984 to 2023, the S&P 500 index returned an average of 11.33% per year. Certainly a good return, and so that's a 40-year period of time, plenty to gauge the performance of the market there. So how many years out of that 40-year period do you think the market returned between 9 and 12% to get around that 11.33%? It was not very often. There were only 3 years during the 40-year period when that happened. So I just think that's a very interesting stat that goes to show when we spread the time out a little bit, we can see great consistent results. But when you zoom in a little while, there's only 3 years within that long period of time where the market actually performed at that percentage point. It would have been a lot higher or a lot lower in most of the years, throughout that period.
Well, and that's a pretty good range that statistic has. I mean, so if your annualized return over a 40-year period is 11%, and only 3 out of those 40 years it was within even a percentage or so of that 11% number, then I guess that is a nice segue to kind of one of the parts of our 3-step plan to help minimize or I guess manage volatility. And boy, that statistic would certainly suggest you want to continue to be consistent in your investment objectives, because only through consistency over that 40-year period of time were you able to get that return. Otherwise, you would have wound up more likely than not with a lot less.
Yeah, no, I mean, I think that stat perfectly illustrates the point of how hard it is to time the market, and we've certainly tried to drive that home so many times. Just the notion of dollar cost averaging, investing often over a long period of time. If you're in there for that whole 40-year period of time, you've got a great return. If you try to time it year to year, you would probably have picked some bad years in there and not done as well.
More often than not, you're gonna miss it, because the reality is timing the market requires 2 decisions that you must get right: when to get out and when to get back in. And I'm telling you, the harder one is the when to get back in, because we see it all the time. And of course, that leads us to the other sort of piece of our 3-step program to try and survive volatility, and that is diversification. We talked about this at the beginning of the program. Not being down as much as the overall markets. That is a credit to having a diversified, balanced portfolio that's got some conservative parts in there as well. And then, of course, the 3rd step would be small doses, if you will, of the media, because right now they are selling fear. And there's a lot of fear out there, and fear is always easier to sell, and it drives up ratings. So just be careful. Consume that in small doses. With that, we're going to take a break here on Dollars and Cents with Joel Garris and Chet Cowart of Nelson Financial Planning.